housing market might start to see some downward pressure on pricing as we get towards the end of the year. And the Cromford report is calling out that we're seeing some similar signs to how we ended the year 2005 to the way that we may end 2024, which doesn't give me the warm and fuzzies. So we're going to talk about that. Also, we are seeing that homebuyers have lost $33,000 in purchasing power, and we're going to talk about why that is. So let's get into it, you guys. So it's election week. We've had a lot of volatility with mortgage rates. I expect we'll continue to see that, but hopefully we'll see some stabilization once we get past the election. So more to come on that. But the Cromford report just came out with some information, and I'm just going to kind of read through some of these important points here because, of course, they say it better than I would myself. But they're talking about our active listings and the fact that our active listings are up, or our total listings are up 37% from the beginning of the year. And this is great for buyers because it means they have more homes to choose from. However, for sellers, there is now a lot more competition. And what we're finding is that these homes are not being taken off the market by buyers as quickly as they had in the past. We don't have the buyer demand. Therefore, these listings are starting to pile up, which is why we've seen this increase of 37% since the beginning of the year. Now, what happens when we have more supply than we have demand? Prices start to go down. But that is not all that they're saying. So they're saying that we have had the number of listings active without a contract has climbed from 15,574 at the beginning of February to 21,368 today. So as you've been watching me every week, I've been sharing our active inventory. This is the latest. We've seen a little bit of a plateau over the last couple weeks, but you can see a really big increase since the beginning of August, and obviously much higher than where we were at in February and the beginning of the year, as they are saying. But they go on to talk about how we can really see what's going on when we look at the contract ratio, which is another thing that I've been sharing every single week on my channel. They say that at the beginning of February, we had a contract ratio of 47.7. That represents a moderate market. Over 60 is hot, under 30 is cold. And today, that same reading is only 32.46. So if we jump over to the contract ratio, we're seeing in February, this is where they were calling out, it was about 47. And where we're at today on this latest reading shows 31.5. So we've definitely gotten to a point where the market is weaker today than it was in February and how we started off the year. It says it's not quite cold, but just above the cold zone. And the last time we saw the contract ratio as low as this in November was a couple of years ago. And that's when the iBuyers were buying off all of that excess, or selling off all their excess inventory at discounted prices. This was right after we saw mortgage rates start to increase at the beginning of that summer. And then our inventory just really increased and everything really kind of screeched to a halt. So that was the last time we saw this kind of contract ratio in November. We also had more than 20,000 active listings at that time, but that count dropped really quickly to 15,000 listings by the following March. It doesn't sound like the Cromford report is that confident that we are going to see that type of absorption rate take place, that type of buyer demand come out to bring down that listing count. The current situation has a less unusual case. We simply have more sellers than buyers, and this is leading to more unsold inventory piling up each week, which, as you know, then leads to price cuts because sellers are on the market for a longer period of time than they anticipated. They begin to cut their prices, and buyers begin to negotiate a little bit harder to try to get a better deal. And ultimately, we start to see sales prices coming down in that type of scenario. Now, the Cromford report says, of course, all of this could change at any point. It really depends on if we see a significant drop in mortgage rates, if there's enough demand all of a sudden that comes out to soak up this supply. More likely is the seasonal reduction in active counts that we normally see every year after the middle of November. So they're kind of anticipating like the number of new listings coming to market to slow down, and this pileup of inventory will stop. But I don't want to say I disagree, but I'm curious to see what happens because from my perspective and all the conversations I've been having with sellers out there is that they want to wait until after the election. So I almost think we're going to see a little bit of a spike in inventory over the next couple weeks after the election, which is all of that like pent up, sellers that are just waiting to get over that hump before they list their homes and trying to, wait out the volatility of mortgage rates and the uncertainty of buyers and the political landscape, et cetera. So I don't know if I fully agree with that, but we'll see what truly happens. They say the seasonal effect is caused by sellers taking their homes off the market for the holiday season, coupled with low number of new listings. But they do say it's very rare that we leave a year with more active listings than we had at the start of November. But this had happened in 2005. So I went back to our active listings, clicking on 2005, and you can see where we started at the beginning of November and where we ended the year. And as they're saying, that's super unusual. That's not what we typically do. However, there's a chance that that could happen this year based on what we're seeing. And they're saying that when that happened, it was a clear signal that the housing boom was ending or entering a bust phase. Wise lenders and developers took notice of the signal. Too many people were not paying attention. They do say, I very much doubt we'll see the same thing in 2024, but you never know for sure. So, as the Cromford Report is always just so, positive about the housing market, does not feel or think that there is any sort of housing crash coming around the corner, that one statement feels just a little bit ominous, in my opinion. Now, truthfully, do I think that's where we're at? No. And I don't think they think that either. However, you have to look at the data and make those comparisons when you see them because, history teaches us a lot. So they say, I advise keeping a close watch on active counts and the contract ratio over the next 8 weeks. So that's what we will be doing on this channel. We are going to look at our active inventory every single week. I always show the contract ratio every single week. So we're going to be keeping tabs on all of that. We also always look at the contract ratio from a map standpoint. And so we'll be taking a look at this every week as well. Every zip code is a little bit different, whether it's hot, cold, in between, balanced, and whatnot. And where we stand today, we have a few zip codes that are on the warmer side. Of course, if you're a seller and you're considering listing your home for sale and you want to know what the kind of heat is in your area, check the description below. We can get you that information so you know where you stand. Now, I mentioned that home buyers have lost a lot of ground. According to this article by Redfin, home buyers lose $33,000 in purchasing power in 6 weeks as mortgage rates hit 7%. And that's really, really tough to believe that you could lose that much ground in such a short period of time. But if you are financing and you're really, dependent on rates, your budget is dependent on rates, this is what has happened. If we take a look at where mortgage rates are at today, we're at 7.09%. As I've said every week for the last few weeks, this is just a super ugly graph considering where we were at in the beginning of September. And there was so much hope that rates were finally coming down. Now we're back to where we were at 4 months ago. So that is the story with mortgage rates. This Redfin article is saying a home buyer on a $3,000 monthly budget can afford $442,500 home with a 7% mortgage rate, the daily average 30-year fixed rate on October 28th. That buyer has lost $33,000 in purchasing power over the last 6 weeks because they could have purchased a home for $475,000 with a 6.11% average rate. And that was the lowest rate that we saw since February. So the good news is the buyer still has $17,000 more purchasing power than they would have had in April when rates were at 7.5%. So, there is your silver lining. But as I've been sharing every week, if you are trying to get a lower mortgage rate, there's a couple options for you. First of all, assumable mortgages could be a really good option. If that makes sense, check the description. I have a list of assumable mortgage options you can take a look at. Of course, if you have questions on that specifically, feel free to reach out to us. And another option is new construction. New construction is offering tons of incentives to buy down your rate and making it more affordable. So don't sleep on new construction if you're interested in something like that. Speaking of which, according to this Redfin article, 28% of homes for sale are newly built. It's the lowest share of new homes in 3 years. But I want to point out that the Cromford report is actually saying that we have had a pretty significant share of sales recently be new construction versus resale. So here in the Phoenix area, we're actually seeing a lot more sales on the new construction side versus the resale side. This Redfin article is looking nationally. And I thought this was interesting to share because it's not really what I would have expected. But they're saying that more existing inventory has hit the market. Therefore, there is fewer new construction sales taking place. House hunters have bought up much of the new construction on the market, so they've kind of taken advantage of this rate buy down incentive and all the incentives builders can offer. And they say that building has slowed down. Home builders have backed off since the pandemic-driven building boom with high mortgage rates dampening demand. They're focused on selling the new homes they have on the books rather than constructing new ones. I am all for that. One of the big problems we had in 2008 was we overbuilt, especially in Phoenix. And builders weren't taking any of these signs into consideration and continued to build and had a surplus of inventory, of new home inventory. So being more cautious on that side, I don't think is a bad idea. Now, we have a big week ahead of us, right? We have the election, and you guys are watching this on Tuesday, so who knows, maybe you know the outcome of the election at the time that you're watching this already. But as I'm recording it, we are not there yet. And so I think we're going to continue to see a little bit of volatility this week as all of that settles in. According to Mortgage News Daily, rates refuse to drop ahead of election, but how about after? So this kind of goes on to talk about that, there's just been a lot of volatility in the market. The way that traders are anticipating the election to go is making them hesitant on what they are going to do. So, for example, they're talking about the jobs report that came out last week, which didn't make huge news. It feels like that was kind of a non-issue because we have so much else to talk about with an upcoming election. But it says today's jobs report reaction provided the latest reason for doubt. Rates refused to drop after a weak jobs report, something they'd normally be happy to do. This was an initial reflexive drop in 10-year Treasury yields as seen in the chart below, but it was quickly erased. Treasury yields are well correlated with the mortgage rates. A chart like this can show us an intraday momentum in the bond market, whereas mortgage lenders only update mortgage rates 1 to 3 times a day, depending on volatility. This was relatively low volume move for a jobs report, further suggesting the market's mind is elsewhere. So I think depending on what happens on Tuesday and throughout the rest of the week, we will see mortgage rates react to that. What they're saying is you kind of have a 50% chance either way. If you think rates are going to go up, you're 50% right. If you think they're going to go down, 50% right. So we'll see what actually happens. Now let's look at the Cromford Market Index this week because we are officially in a buyer's market, you guys. And by the way, if any of this is helpful for you, make sure you share this video with someone who would find it interesting or hit subscribe, hit like. I would love for you to continue to be a part of this community. So 89.9, technically a buyer's market throughout the Phoenix metro area. You can see our supply keeps climbing, 85.4, which is about 15% below normal on supply, but it is, 9 points higher than our demand. And our demand is sitting at about 24% below normal. So this demand is just not keeping up with the supply. Supply continues to grow. Therefore, we are seeing an imbalance. And when there's more supply than demand, buyers have choices, buyers have negotiating power, sellers start to get a little more, I don't want to use the word desperate, we're not there, but, a little more flexible in order to get the job done, right? So that's what's happening as far as the CMI across the valley. If we look at every city in particular, again, seeing a lot of red arrows. No surprise there. That's ultimately what's happening across the valley. And Typically this is a slower time of year too, but then you add in the election, all of the hesitation, the pausing. It's just really hard to get a read on exactly what is going on with the market right now, not to mention the big spike in rates after everyone felt pretty confident we were on a downward trend. So a few curveballs here, for lack of a better term. As far as the CMI change over the last month, it was 4.8% this week to last week. Last week we saw that was a negative 4.8%. Last week it was negative 4.5%. So there is, again, some acceleration in our direction towards a buyer's market. Not surprising. That's just what we saw in the CMI now that we are officially in that slight buyer's market. So as a buyer out there, you're getting into a time of year that is traditionally a better time to be a buyer because you have a little bit more negotiating power with a seller. Add in the fact that there is some market uncertainty right now. You may have a really good opportunity to buy over the next couple months and take advantage of things like assumable mortgages or new construction where they will buy down your rate. So check the description for more information there. And sellers, if you're curious about your home value, I got an instant home value link. And then I also have that contract ratio in your zip code, which might be really helpful for you to understand what's going on hyper local, where you're living, and whether or not it makes sense to list your home. So have a great election week. I'll see you guys next week on my next market update.